So now we are going to 5A. So company A wants to invest in project, the life of which is expected to be 4 years. So the life of the project is 4 years. So annual net profit is expected to be 20,000 after charging yearly depreciation of 16,000. So in order to write off the capital cost of 64,000, so capital cost of here is 64,000. So out of the capital cost, 40,000 is payable immediately. So at the beginning of the year, that is year 0. So 40,000 we are paying immediately. So that remaining, that is 64 minus 40,000. So that balance 24,000 at the year end, next year end. So remember, next year end. So 24,000 we are going to pay on first year end. Okay. So that is 0.901 we need to apply for calculating present value here. Stock amounting to 12,000 to be invested in year 0 will be required throughout the project, and for debtors, a further sum of 16,000 will have to be invested at the end of year 1. So stock, that is working capital requirements, this and all. So working capital requirements, we have so for working capital requirements, we have debtors as well as stock. So this should be invested at the year 0, that is beginning of the year, and this should be invested at Y1. So here we are investing at Y1. So working capital will be recouped at the end of the year 5. So this 16,000 and 12,000 will be recovered at the end of the 5th year. So it is expected that machinery will fetch a scrap value of 4,000 at the end of 4th year. So income tax payable is 40%, depreciation equals the taxation writing down allowance 25% per annum. Income tax is paid after 9 months. So remember, income tax here, this is the tricky point we have. After 9 months, after the end of the year, that means for year 1, if I'm incurring, say for example, 10,000, I will be paying when? During the year 2, I will be paying. So this is a calculation we need to be calculated properly. So here tax rate is 40%. So remember this as well. So 40% we are going to pay. That means net profit is 20,000 here. So net profit 20,000 for every year. So tax rate will be 40%. It is 20,000 into 40%. That means 8,000 we are going to pay every year, right? So for year 1 net profit 8,000 we are going to pay on year 2. So likewise we are going to calculate. So the project is only for 4 years. So we need to calculate for 5 years then. So because 4th year tax we are going to pay for 5th year. So we need to calculate present value for everything based on 5 years. So residual value of 4,000 will also bear tax at 40%. Since the tax paid is in the next year and the working capital is recouped in the 5th year cash flows, calculation will be required up to 5 years. Then taking discount factor of 10%, calculate NPV of the project and give your comments regarding its acceptability. So they have calculated for present value 10% they have given. So now we are going to calculate present value of annual cash flows first, that is cash inflows first. So PBT, profit before tax, we have tax. So here it is year. Depreciation. So cash flows after tax I'm going to have. Then present value factor at 10%, then present value of cash flows. So year one. So for all the years, profit before tax is 20,000 rupees. So till fourth year, we are going to recognize this. So for tax rate, so 20,000 into 0.4, that is 8,000 I'm going to pay at the second year. So here 8,000 on second year profit I'm going to pay on third year. So third year's profit I will be going to pay tax on fourth year, and fourth year's profit tax will be payable on fifth year. So this will be the calculation. So depreciation is 16,000. So for 4 years, we are going to calculate 16,000. That is, it comes to 64,000. The machinery cost will be completely written down. So now I'm going to calculate cash flows after tax. So 20,000. I have want to add back this depreciation because this is a non-cash item. So 36,000. Here in the same way, 20,000, I want to pay tax minus tax plus 16,000. So 28,000. Here it is for the fifth year, it should be minus because there is no inflows, only outflow, that is tax. So now I am going to apply 10% present value factor, that is 0.9091. 0.9091, 0.8264, 7513, 6830. Six two zero nine. 6209. So I want to multiply this cash flows after tax along with present value factors. So I will be getting a total of 91,060. So now what will I will be realizing? Salvage value, right? So I will be realizing salvage value. So present value of salvage value after tax I want to calculate. So salvage value, how much it is? So I'm going to realize salvage value 4,000. So this will be required on year fourth, right? So I'm going to dispose that year machinery on year fourth. So I will be getting 4,000. So salvage value will be realized on year fourth. So year four. So salvage value is 4,000. So in this amount, I want to calculate present value. So for the fourth year present value, that is 0.683. So now I am going to multiply this. So I will be getting 2732. I will be getting. So for salvage value tax, when I am going to pay? So year 5, right? So tax payable will be on year 5. So how much percentage it is? 20 percentage. Sorry, 40 percentage. So that is 1,600 will be going to payable on year 5. So year 5 is present value factor is 0.6209. So this 993 I am going to pay. So I will be getting a sum of 1738.56. So salvage value after taxes 1738.56. Then I'm calculating present value of working capital. So recouped at end of year 5 they have given. So it is working capital the 16,000 and 12,000. I am going to recoup at the end of 5th year. So debtors plus stock, that is 16 plus 12,000. This is my working capital. So I'm going to recover on 28,000. This is going to recover on year 5. So year 5 is present value factor is 0.6209. So my present value will be 17.385. So now I'm going to calculate all the outflows. So this and all inflows, right? So total present value of inflows. So all the inflows, that is 9160 plus 1738 plus 17385. So this is my present value of inflows. So now I'm going to calculate the present value of outflows. So what is the outflow? First, I'm having investment. So investment for that machinery. So investment, how we are going to make. So for investment year 0, I'm going to pay 40,000. So balance at the end. So year 0, that is beginning of the year, I'm going to pay 40,000. So present value factor will be 1. So here it is 40,000. Then next year, I am going to pay the remaining. So total of 64,000, I have paid 40,000. That means that balance 24,000 will be payable at the year end. So 24,000 will be payable on year end, that is 0.909 present value factor. So this will be 21,816. So then we have working capital, right? So working capital, we are going to contribute on the stock will be contributed on year 0, that is 12,000. So stock, that is 12,000. That is contributed at the beginning of the year. So present value also same. Then debtors 16,000. This is contributed at the beginning of the next end of the first year. So 0.9091. So total will be 26,545.6. So total cash outflows. So 83. So I'm going to calculate net present value. That is 110, 184 minus 88, 364. So I will be having 21,820. So inflows minus outflows, this is. So NPV is positive since NPV is positive, we can accept the project. So next one. So a company has to replace one of its machines which has become unserviceable. So two options are available to the company. A more expensive machine that is premium with 12 years life, a less expensive machine with standard machine that is 6 years life. So if standard machine is chosen, it will be replaced at the end of 6 years by another standard machine. So we are going to replace it with another machine. So it will be covered for 12 years. So the pattern of maintenance, running cost and prices is as under. So purchase price 40 lakhs, here it is 28 lakhs. So scrap value overhauling is due at the end of the 8th year, and here it is 4th year. So overhauling cost, annual repairing expenses, cost of capital, everything they have given. So you are required to recommend which of the machines should be purchased given present value interest factor PVIF for 14 years. Here it is for they have given annuity factor that is cumulative one. So for 1 to 6 years they have given, and for 1 to 12 years they have given. So we need to calculate what is the cost involved for both the machines, that is for premium and standard. Then only we can decide which one is preferable. So first I am calculating premium machine. So purchase cost, that is purchase price, that is 40 lakhs. After that, we will be having annual repairs, right? So annual repairs. So present value of annual repairs. So how much is it for annual repairs? That is 4 lakhs. So every year I'm going to incur that. So for 12 years, annuity factor is 5.66. So usually students will have doubt when we can apply this annuity factor and all. So whenever that income or outflow is constant for all the years, then only we can apply that annuity factor, or else we should not apply this. We can go for present value factor for each and every year. So that is 5.66. So that is 4 lakhs into 5.66. So this will comes to 22 lakhs 64,000. Then we are having overhauling cost, that is 8 lakhs, which is due on 8th year. So 8th year PV factor is 0.3506. So overhauling cost, eight lakhs into 0.3506. So 3.506. So here scrap value at the end of the year, that is end of the life, 6 lakhs. So will be realized on 12th year. So this is an income for me. So less scrap value. How much I'm going to realize? 6 lakhs at the end of their life. So that means 0.2076. 6 lakhs. So this is an income for me. So I want to reduce this. So together I will be having 64 lakh 19,920. So now I am going to calculate present value of cash flows for standard mission. So what is the purchase cost for this? 28 lakhs. So purchase cost is 28 lakhs. So repairs is 5,60,000. So annual repairing is 5,60,000. So 5,60,000. This is for 6 years, right? So this machine is for 6 years. So for 6 years, what is the annuity factor? 3.889. So 5,60,000 into 3.889. Then overhauling cost. So overhauling cost here it is 4 lakhs will be due at the end of 4th year. So 4 lakhs into at the end of the 4th year, that is present value factor at the end of the 4th year is 0.5921. Then scrap value. So scrap value 6 lakhs. I'm going to realize on year 6, that is 0.4556. So this total outflow is 49,41,320. This is for 6 years. So again, we are going to replace this. So we will be getting twice this outflows, right? So 98 lakh we have to incur. So this is one of the way. So total outflow. So I'm going to replace this again. So this will be you can do in this way. So if I'm comparing this, premium machinery outflow is cheaper. So I can go for premium machinery outflow. So in this way, you can calculate, or else we can calculate equated annual cost cash outflows, because this is 12 years and this is for 6 years. So we can't compare as it is. So we can calculate equated annual cost of machine. So that means how you're going to calculate total cash outflows divided by annuity factor, that is 6. So total cash flows divided by annuity factor. So that is for premium mission, that is 64 lakh 19,920 divided by my annuity factor for all the 12 years, that is 5.66, right? So I will be getting 1 lakh 13,000, sorry, 11 lakh 34,261. Here it will be for 6 years, that is 49 lakh 41,320 divided by 3.889. That means I will be having 12 lakh 70,000 as my outflow. So here also cash outflows is less for premium mission. So we can go for premium mission. Premium machinery can be selected because of low air cash outflows compared to standard machine.